Welcome back. I hope you're having a fantastic day. Markets are a little up and down today. We're going to start out with traditional markets. As you know, we cover the entire macro scene, traditional markets, Bitcoin and crypto, as well as real estate and the housing market, because they are all tied together in the global macro environment that we're experiencing right now. Markets started down a little bit today, bounced back around noon, which they often do, and are accelerating towards the downside again at 1:25 Eastern Standard Time is when I'm recording this right now. So again, the importance is the close. What does the market do into the close? You want to watch that momentum into the close. If they're selling into the close, then that gives you an idea of investor sentiment as well as outlook. And right now it's risk off, take chips off the table. The Fed came out, tickled the market the other day and said, we're not going to raise interest rates any more than half a point at a time. Markets initially rallied on that until they realized what that really meant was that the Fed is not going to get control of inflation. They're still behind the curve and they have lost all credibility with investors around the world. So that's where we're at right now. The Fed has lost all credibility on inflation and the ability to control and or fight inflation. Recession is probably imminent, which again is just negative GDP for 2 consecutive quarters. It can be very minor. It sounds like a bad thing, but it's just negative growth. And right now, the environment we're in, you just can't predict growth. And that's what's kind of affecting the stock market is companies are not providing much forward guidance at all. And if they are, it's kind of meager. So that's affecting earnings across the board. But as we get into looking at different indicators in the market, some analysts and economists are saying and thinking that inflation is peaking or has peaked. And some inflation will be temporary and or transitory, but there is obviously more inflation that's baked in and more systemic and is going to be long lasting due to the job market and people exiting the job market. It's been the great resignation that we've been experiencing since the pandemic, people looking for more flexibility, more opportunity, and the ability to call their own shots, carve their own path in their own future, and create what it is they want out of their lives. So really interesting. We had job numbers come out today. Now, one thing is a lot of the Fed members are going to be speaking today, and then we have the CPI print next week. So markets are going to be reactionary to those things as, headline risk is a real thing in the markets right now, extremely volatile. So we're going to jump in and take a look at the charts because there's no real big news standing out. Just wanted to kind of give an update on the markets. Everything's down 0.5% to 1% across the board right now. NASDAQ obviously down the most at almost 1%. S&P and Dow are down about 0.5%. We're going to look at the daily. So let's look at traditional markets first, because there's a couple of things that I want to touch on. And the Dow Jones right now is working on putting in a new lower low, taking out this last low right here that was put in on March 22nd, and pretty much all of the markets, Bitcoin, all of the crypto, S&P, NASDAQ, everything is working on taking out that March 2020 low, or 2020, March 8th of 2022, the 8th of March 2022. And this is a wick here, but we look at the closing basis and the Dow Jones is working on that. If it takes that low out, then you can look for more continuation on the downside. And I know there's a couple of people out there kind of thinking that maybe the market's going to kind of bounce around in here and then kind of take off again. And again, that's just not a realistic expectation given the environment that we're in with monetary policy, rising interest rates, inflation, the war, China lockdowns, all of the things, the liquidity issues that we have that are structural, that are not priced into the market. So what the market is pricing in right now is interest rate policy, potential for a little bit of recessionary environment. But what the market has not priced in is the structural damage that the liquidity and lack thereof can do to the markets. And that is kind of what is driving the sell-off to a degree, but it's not priced in yet. So that's the next leg down that will have to get priced in as markets continue to unwind all of the QE that's been pumped in the market since March of 2020, when the pandemic hit. And the thing to understand is these things take time. So a lot of people in the markets right now in crypto and in stock markets were not around back in 2009. So all they know people, even maybe you that are watching this right now, maybe all you know is a bull market. So you haven't seen anything prior to the last, 10 to 12 years where the markets have been in a risk on, do not fight the Fed, buy the dip, hodl market, because we've been in a QE market where the Fed's been pumping liquidity into the market, as well as zero interest rate environment since basically March of 2009 after the big sell-off in the great financial crisis. And if you look at how these things happen, this is where we are right now. So this was back in July of 2007, and going into 08, it took about a year for the markets to really tail off and hit bottom. So this is kind of how it starts. The markets peak, they have, dips and big jumps and dips and big jumps and rallies and rebounds. And then you get into this consolidation phase. And this is where several people out there right now are calling for markets to just consolidate and go to new all-time highs. And, that just isn't what happens in a bear market with the Fed out of the game right now. The Fed's going to let the markets break. They're going to look for a bottom before they jump back in, and it becomes risk on. So, the interesting thing is that when you buy at the top like this, like you have investors like Kathy Wood that says, hey, we have a 5-year outlook, so we can buy at any price. Well, if you bought here at the top of October 2007, which is the equivalent of where we just came from in December of 2021, the peak of the market, and said, hey, I got a 5-year outlook. Well, let's look at where 5 years is. So that's October of 2007. So we need to go forward to October of 2012. So October of 2012, you were still out of the money. You were still down from your initial peak investment. So it took really to get back to that level. It didn't really happen until 2013. So it was 6 years before it got back to that level. And again, that was with massive quantitative easing, massive liquidity injected in the market, zero interest rates for all of that to occur. So let's take a look at the spectrum again and go back to the dot-com bubble. And this is the Dow Jones during the dot-com bubble. And again, that peaked back in 2000, 2001 during this period here. The Dow Jones didn't take as big of a hit as the NASDAQ did. But again, if you bought at the peak here, which was January of 2000, it took basically to get back to that level 6 years just to get back to even. So, having a 5-year outlook, buying at the peaks without the Fed involved, it took 6 years to get your investment back. And then it went on from there. And then the market crashed after that in 2008, 2009, because of all of the speculation. So you got to be careful with, these long-term hodl, calls that people are saying, oh, just buy and just have a long-term outlook, have a 5-year outlook, 10-year outlook. That doesn't always work. If you look at the NASDAQ, let's look at the dot-com bubble, because crypto is basically a tech stock. So you got to think about, what happened in the dot-com bubble. And here it is right here. A lot of these companies, massive euphoria. And if you look at the tech sector, the NASDAQ, and if you look at crypto, which is highly correlated to tech stocks, especially Bitcoin, we saw an 80% drawdown in the NASDAQ. And really it took, if you look at the NASDAQ, let's go to the weekly here so we can kind of get this into perspective. It was a blip in the whole scheme of things, because here we are basically 22 years later, and you can see, the market is at 16,000 versus, 4,000. So it went up 4-fold in a 22-year period. But if you look at this time period here from, basically March of 2000 until December of 2015, it took 15 years just to get back to even after that initial bust from the dot-com bubble, because it was so exuberant and it was such a huge bubble. So the question is this kind of the same type of thing that's happening in the NASDAQ right now? How big was that bubble without the Fed involved? How far down will it go, and how long will it take to come back? And a lot of people are fooled here, because again, a lot of investors, all they know is basically 2009 forward. And the market did not shoot straight up from 2009. It was more of a steady, slower decline versus this big spike that we had after 2020 pandemic lows, when all of the markets shot straight up. So that's the big issue that we're having right now, is this liquidity that was injected into the markets from that 2020 low that's just been straight up. So that's what's unwinding, and arguably should revert back to the levels that the market was at before the pandemic, because it was still a Fed-induced, QE, zero interest rate environment, but inflation was a little bit was under control. We didn't have the issues because obviously the pandemic created a lot of the inflationary environment. So you can fully expect markets to get back to these levels, if not even lower, as we continue right now. So that's traditional markets. That's just what to watch out for, because a lot of investors, again, even maybe you're watching this today and you don't know anything other than bull market on, buy the dip, hodl from 2009 forward, because you just haven't been through any of these bear markets or recessionary environments. And we've got them both. We've got recession, we've got high inflation, and we have bear market conditions. And it's going to take a while for all this to unwind, unsettle. We have the war, just a lot of different things going on, a lot of headwinds in the market. And that's why, what's happening is what's happening. So on Bitcoin, on the daily, Bitcoin right now is testing these lower levels, that $35,000 macro, well, not macro, but local bottom that we put in back in January of 23rd January of this year, after the initial big sell-off. I called that bottom and said our local bottom is 35,000 based on a few indicators that we were looking at, and took a lot of criticism for that. People said you can't call bottoms, and it's held up ever since then. And what I was looking for was that retracement, back up to the $55,000 to $57,000 level before the price would roll over into a longer consolidation or bear market retracement back to lows, and to test these macro market structure lows. But it looks like it may not get there. It looks like, just because everything that's happened, and the invasion of Ukraine back here a few months ago, back in February, when the markets took the initial big hit. And the interesting thing is, this looks a lot like where we were in 2018, after the peak. So if you take the high of 69,000 and you roll over here, Bitcoin's been basically in a downtrend for 178 days. So if you go back and you look at 2018 and say, okay, what does that look like back then? And let's go over 100. Let's go over 180 some days, and that puts you right around this area right in here. So right around in this area here, before more downside bounce, and you just kind of work your way to a capitulation. So kind of this consolidation area here is what things are looking like right now, based on the number of days after the peak. And if you come over here, that's kind of where it looks like Bitcoin after this little rise, in that little consolidation period right there. So what I'm saying is, this area here looks a lot like this area right here. After the big drop, it's about the same amount of days as it works its way ultimately to a low. The question is, where is that low going to be in this cycle? And back then, that low was obviously, let's see where that landed, 83% of a drawdown. So if you take 83% from here, where does that put the price? 83% is right at $11,000. And, it'll be a lot of work and some more systemic macro environment situations and events to drive the price down there. So what I'm looking for right now, obviously, is for Bitcoin to take out this low here. This is a wick low at 33,000, but this $35,000 close below $35,000 and start working its way back to the last low that we had on this range here, which is that $29,000 level. And that's what Bitcoin is working on doing right now, in terms of breaking this parallel channel that we've been following, that price has been kind of locked in here for the last several months. It's working on the bottom leg of that channel. So if price breaks below that channel, then that is when you can expect more significant downside tests. So that's what we're looking on there. And if you look at the moving averages right here, you can kind of see it's still below all major moving averages, but the weekly is the critical one. As we've been talking about in the past, whenever price breaks that 100-week moving average, it goes down to the 200-week moving average. This is the 50-week, this is the 100, that's the 200. Every time in the past when price has broken the 100 and closed below the 100, it goes down to the 200. Pretty much every time in the history of Bitcoin, it has done that. So that's what we're watching right now. These are the things that I am looking at. So we'll just have to see how things develop and watch that price action into the close to see if there's more downside and where the markets ultimately settle. But you want to watch that close below the parallel channel, which is below the 100-week moving average, to see if the price ultimately goes down to check the 200-week moving average, which is around $24,000. So a lot to keep an eye on, and I will see you on the next video.